Just open that PDF, shares PDF, which I have sent.
Yes, ma'am.
Yeah. So now what is shares? We are going to understand. Public company, like public limited company is there. So suppose in order to start any business in a big company, suppose a big company wants to be established, huge amount of funds are required and it is not possible to bring from home. Just a moment. Pavitra, good evening, dear. Pavitra?
Good evening, ma'am.
Yeah, just open that PDF issue of shares chapter. We are starting that. So a large company needs huge amount of fund to be raised in order to start a business. It is not a very small amount that can be brought from home. Like in partnership, the partners, they bring capital from their home and start a business because it's a small business. But when we talk about a company, it's really very big, and with small amount it cannot be started. Huge amount of funds are required and it is not possible for the for the person who started the company to bring a loan from home and start a company. So what they do, they take help of public. Public means who? We are public. So what they will do, they will announce or they will publish in newspaper, through TV news, through newspaper, through magazines, that a particular company is going to be started and they need fund. In order to raise fund, they will issue shares. Shares means, for example, the company needs, for example, 1 lakh rupee. This is very small amount, actually more than crore it takes for a company to start. But for example, in order to make you understand, I am telling the small amount. So for example, suppose a company needs 1 lakh rupees. Then what the company will do, the total capital required by the company is 1 lakh rupees. This 1 lakh rupee company will divide into small parts. For example, 10 rupees. 10 rupee means a share will be issued to public of 10 rupees. So you have to divide 1 lakh, okay, divided by 10 in this way. So 10,000 shares will be issued. Number of share 10,000 will be issued to public. Company will call the public, please come, those who are interested, you buy shares. Each share is 10 rupee. So if suppose a person buys 5 share, he will pay 50 rupees. In this way, the 10,000 share will be sold by the company to public, and suppose the public is purchasing all the shares, different people. Public means it includes large number of people. Anyone can, who are interested, can go and purchase share of the company. Then what will happen? In this way, company can arrange easily that 1 lakh rupees from large number of people. Now in return, what the company will do? Company will pay the dividend to the shareholders. Now who are shareholders? Those person or those public who purchase that shares of the company, they become shareholders of the company. Now shareholders are owners of the company. Suppose a person has purchased 5 shares. each share 10 rupees. So 50 rupees share he purchased, then till 50 rupees he became owner for that company. In this way, suppose a person has purchased 3000, 4000 amounted shares, he becomes to that amount owners of the company in this way. So shareholders are owners of the company. Now whenever the profit by arranging or raising funds through public starts the business, then whatever profit is earned, who will enjoy? Obviously the owner will enjoy. The person who has given how much capital, they will get accordingly the dividend. Okay, in this way the company raises funds through public, and total amount of capital required by the company is divided into small parts, and in this way company raises funds, and in return it gives the profit according to the purchased number of shares to the shareholders, and that profit is known as dividend. You are getting my point? Any doubt in this? What is share and how the company is raising fund and all?
No, ma'am.
Okay, fine. Now see, suppose company wants 1 crore, then it issues shares to public for raising funds. As I told you the example of 1 lakh, this is 1 crore, the total amount of capital required by the company. It divides into small equal parts and raises funds through public. For example, company issues shares 20% of 1 crore to public. The whatever company earns profit, 20% of it will be given to shareholders. Suppose the company requires 1 crore, and at present immediately out of that 1 crore only 20% of 1 crore are issued in form of shares. Then whatever profit company is earning, then 20% of that will be given to the shareholders. Shareholders are owners of the company, as I said. The amount received by the company by issuing shares to public are called share capital. So what is share capital? The total amount received by the company from the shareholders. That is known as share capital, and it's a liability. Remember, capital is itself a liability. In partnership we use the word capital, but in company we use share because company is like receiving capital in form of shares. So share capital, it's a liability, we have to credit it. Whenever in future the company shutdowns or closes, the shareholder will get their amount of their amount they have invested during purchase of shares, that amount they will get back. Till that they will be receiving dividend, that is a part of profit. Two types of shares. There are two types of shares: preference share, equity share. And this equity shareholders, they are owners of the company. Remember this. Preference shareholders, they are not the owner. Equity shareholder are owners of the company. But remember one important point: whenever the profits are earned by the business, first preference shareholders are given dividend. Okay, there are two type of shareholders. First, always preference shareholder will be paid the dividend, then only equity shareholder will get the dividend. Okay, three types of share capital. Now share capital, how many types of share? Write it on all these, try to write it down. So there are three types of share capital: authorized share capital, issued share capital, subscribed share capital. So there are three types of share capital. Write it down everything. Now see, MOA means Memorandum of Association. AOA you all know in business studies, you must have studied Article of Association. In AOA, company, what are the rules company should follow will be written. All these are legal documents. MOA, in that object of the company, how much total capital is there in the company, what are the liabilities of the company, where the company is having its registered office. All these important details are given in Memorandum of Association. Example, suppose 20 crore. Suppose in Memorandum of Association, total capital required by the company in its future is 20 crore. Till the company exists, till the company runs, it requires 20 crore capital. So only that much capital can be raised by the company through public. Remember this. If in MOA, that is in Memorandum of Association, these documents are prepared before starting the company. Before starting the business, these legal documents are prepared. So in this, they will clearly write the total requirement of the capital throughout the life of the company. If it is written 20 crores, more than 20 crores, company cannot raise capital, cannot issue shares, cannot raise fund. Limit is 20 crore, whatever written in MOA. So remember this. Now suppose one share is 100 rupees. So 20 lakh share the company should issue in order to get 20 crore rupees. So this is authorized share capital. What is authorized share capital? Authorized share capital means the total amount of capital that a particular company can raise in its lifetime till it exists. Suppose in MOA, Memorandum of Association, it is written 20 crore. More than 20 crore company cannot raise the fund. The limit is 20 crore in its life, and it is not necessary at the same time 20 crore company should raise fund. Suppose at present company needs 10 crore for example. So 10 crore it can issue shares for 10 crore and it can get that, and after like few years, 10 years or whenever the company needs, rest of the 10 crore it can issue. But more than 20 crore it cannot issue in its lifetime. That is only authorized share capital. Any doubt so far? Pavitra, Sachin, any doubt you people are having?
Ma'am, can you repeat the definition for authorized share capital?
Yeah, sure. See, authorized share capital means the total amount of capital that a company can raise in its lifetime. Suppose 20 crore is written in memorandum of article, it means the company cannot raise more than 20 crore in its life. Suppose the company runs for 50 years, 60 years. Till that company can raise only 20 crore, up to 20 crore, not more than 20 crore, because it is the maximum limit for the company to raise the capital and written in Memorandum of Association before starting the business. So that is only authorized share capital, total amount of capital that a company can raise in its future, the limit, maximum limit. Now it is clear, Sachin?
Yes, ma'am.
Yeah. Pavitra, it is clear to you, dear?
Yes, ma'am.
I hope you people are writing, write it down. So now authorized share capital means a company has authority. Authority means right to raise 20 crores from public in its lifespan as per MOA. MOA means Memorandum of Association. Suppose out of 20 crore, only rupees 5 crore of worth shares are offered to public, then rupees 5 crores are issued as share capital. Suppose company at present don't want the entire 20 crores. Company doesn't need 20 crores immediately. So company may issue 5 crores, 10 crores, whatever amount it is required at present through shares to public. Rest of the amount it can issue later on. So it depends on the requirement of the company. It is not necessary at one time company should issue 20 crore. Okay, it depends on company how much the requirement. Slowly it can issue shares. You have any doubt dear so far?
No, ma'am.
Okay. Okay, fine. So next. Okay. Suppose 4 lakh shares are purchased by public, then 4 lakh shares are called as subscribed share capital. Now what is, okay, issued. Okay, see, what is issued share capital? Suppose authorized share capital is 20 crore. In memorandum of association it is written that during lifespan or lifetime of a particular company, company can issue up to 20 crores of shares. Now the company at present want only 10 crores or 5 crores. Now company is issuing shares only for 5 crores because its requirement is 5 crores for the time being. Afterwards it can issue as per the requirement, but for the time being only. So the total number of shares that the company issues to public or offers to public means company is asking public to come and purchase its shares. So the total number of shares issued by the company to public, that is the issued share capital. We learned that there are three types of share capital: authorized, issued. So issued means the total number of shares issued by the company to public. That is only issued. It is not necessary that authorized share capital should be equal to issued. Why? Because if authorized is 20 crore rupees and company needs only 5 crore for the time being, so issued share capital will be 5 crores and authorized will be 20 crores. Are you understanding the difference between authorized, issued?
Yes, ma'am.
Yes,
Yes,
Sachin?
ma'am.
Okay. Now we are moving to subscribed share capital. Suppose I am a shopkeeper. Forget about the company. I am a shopkeeper. I have 10 soaps. I am offering to my customers. Customers are in queue, and suppose I am able to sell. I am offering. I am saying that I have 10 soaps with me. Suppose Mysore sandal soap, just for example. I have 10 Mysore sandal soaps and I am ready to sell. This is only offering. What is offering? I am ready to give my product to customers, whatever I am having. So if I am having 10 soaps, I can sell only 10, not more than that, because I am having only that much. So 10 soaps I am having, I am ready to sell to my customers. Customers are standing in queue. But I am able to, there will be a lot of conditions. I don't know how much soap I will be able to sell. It is, what will be the probabilities or chances? First, you can say that all my 10 soaps can easily be sold out. All the customers will come and purchase my 10 soaps. Sometimes there are chances that only 5 soap will be sold out, remaining 5 will be with me. Sometimes no customer may come due to any reason. I may not be able to sell all my 10 soaps. So there will be lot of conditions, lot of different cases. Same with company. Company is offering, company is ready to sell its share for worth 5 crore to public. But it is not necessary that at a time that all public will rush and purchase 5 crore. Not necessary. Sometime 4 crore public may purchase, 1 crore may not be sold. Sometime more than 5 crore company may demand 6 crore, 7 crore, that much. So in this way different situations are there. So subscribed share capital means how much the public is subscribing, how much public is purchasing. Issued means how much company is offering to public, how much company is issuing the shares, giving the shares to public for purchasing. Subscribe means how much public has purchased. So subscribed share capital means suppose company is offering 1 lakh or 1 crore rupees. Public may subscribe entire 1 lakh, or public may subscribe 90,000, or public may subscribe means ready to purchase 1 lakh 10,000. Are you understanding the situations, conditions? Are you understanding what is subscribed share capital?
Yes, ma'am.
Yes, ma'am.
Yeah. So try to understand all these very important concept. Authorized, total amount of capital company can raise in its lifetime, and it should be there in memorandum of association. Company cannot raise more than that amount. And issued share capital, then total number of share company is ready to offer to public. Subscribed, how much public has purchased. Means company is offering 1 lakh. How much public has purchased? Entire 1 lakh or 80,000, 90,000, 70,000, all these. So subscribed means total number of share purchased by the public. Issued means total number of share offered by the company to public. All these. Now see, there is one important rule. It is written in Companies Act. So the company says, suppose total number of share issued by a company is 1 lakh. So in that, minimum subscription should be 90%. Minimum 90% of the issued share should be subscribed by the public. Then only company can start its business. Less than 90% of issued share capital, company cannot start its business. So this is the rule. If there is more than 90%, well and good, but less than 90% of issued share capital, not allowed. So minimum 90% of the issued share capital the public should subscribe in order to start a business and company. Yes, understood, dear?
Yes, ma'am.
Okay. So subscribed share capital are of 3 types. Now when we are talking all the 3 conditions I told you. So first is full subscription. There are 3 types of subscribed share capital. First one, full subscription. Write it down everything. Now what is this full subscription? Suppose company offered 5 lakh shares. Company is ready to sell 5 lakh shares to public and only 5 lakh shares are subscribed by public, then it is full subscription. And the company is able to sell its 5 lakh to public. Public is also ready to purchase only that 5 lakh. Means the subscription came only for 5 lakh. So 5 lakh company is offering, subscription from public side also came for 5 lakh. So it is full subscription. This is the case of full subscription. Understood what is full subscription?
Yes, ma'am.
Yeah. Suppose a shopkeeper is having 10 soap to sell. Customers are also coming only for that 10 soap. And customers are purchasing that 10 soap. So it is full subscription. Now the second case. Under subscription. Suppose company offered 5 lakh shares and only 4 lakh shares are subscribed. Then it is case of under subscription. Company is ready to offer 5 lakh, but how much subscription, how much the public is subscribing? Only 4 lakh. You can take the example of who? That shopkeeper. Shopkeeper is ready to sell 10 soaps, but customers are coming for purchasing only 8 soaps. So it is under subscription. So under subscription is clear?
Yes, ma'am.
Okay. Now the next, over subscription. Suppose company offered 5 lakh shares, the same example we are taking, cases are different, and only 6 lakh shares are subscribed. Now company is ready to sell 5 lakh shares, but subscription came for 6 lakh. People are asking 6 lakh shares from the company, but company cannot give 6 lakh because company is having only 5 lakh shares. So you can just take the example of that shopkeeper. Shopkeeper is having 10 soaps only to sell with him, but customers are coming for 15 soaps. Other 5 from where he will get? He will say, I am having only 10 soaps. You kindly purchase these 10 soaps from me. Okay, but he have options that we will study later on. That 10 soaps, see, you can think in this way. That 10 soaps, if suppose 5 persons came and they are asking 15 soaps. For example, 5 persons came, each one of them are asking 3 soaps. So in this way 15 soaps they are asking. Shopkeeper is having only 10 soaps. He have lot of options. He can just give like what? He can distribute that 10 soaps like 2. Each of them he can give 2 even though they ask 3. Or he can give to 2 persons 5 soap, rest of the 3 persons he can reject. In this way lot of options he is having, that we will study afterwards. So till here I hope it's clear. Full subscription, under subscription, over subscription. Very, very important concept. Try to catch the concept. Yes?
Yes, ma'am.
Yeah. Pavitra, are you getting, dear?
Yes, ma'am.
Okay, now called up, paid up, again very important concept. See, what is called up, what is paid up? 5 lakh shares of rupees 100 each. Suppose number of shares 5 lakh and each share is of rupees 100 each. So, see what will happen, company will not ask this entire 100 rupees at one time. There is a rule, company will ask in installments. Like first company will ask during application, whoever is interested. Suppose I am interested to purchase share of a particular company. So I will reach the company through online mails or whatever facility available. I will purchase the number of shares I am interested. So during that purchasing time, the company will say application money per share is 30 rupees. So if I am interested, I can purchase 5 shares, 10 shares, 1000 shares. It depends on me. So I have to pay per share 30 rupees as application money. Once I pay the application money and suppose the company is ready to give me that number of shares as asked by me, then I become shareholder. I become shareholder of that company. Now after 1 month, 2 months, again what the company will do? Company will ask rest of the amounts in little amounts. For example, next suppose December month, application money I am paying 30 rupees and I became shareholder of that company by purchasing the shares in this way. Now in January month, company will remind me, since you are shareholder of this company, now you have to pay 20 rupees on allotment. So like this 50 rupees company collected out of 100, first 30 on application, then second 20 on allotment. Now after that on February again company will remind me that you have to pay the first call, that is your installment. Name of that installment is first call, second call, application, allotment. So that company should know like which is company, which one company needs to ask, which installment company already received. So for making all these easy, we are keeping names of the installment, like first application, then allotment, then calls. Calls may be 1, 2, 3, anything. First two will be application, allotment. Rest of them will come under calls. So first call February 30, then the second and final call 20. So in this way company will take 100 rupees from each shareholder during different installments. You got it, how company is taking 100 rupees from shareholders?
Yes, ma'am.
Okay. 5 lakh share of rupees 25 each, lump sum. Now there are chances, everything depends on company. There is no hard and core rules. In installment company may take in this way, or suppose the company needs money in lump sum. Company doesn't have a single pie in its hand and it's what? Lump sum. Then it can't wait for the installments. So at that time what company will do? Company will ask the shareholder to pay lump sum. Lump sum means 5 lakh share of rupees 25 each. Suppose 25 rupees share, each share cost 25. Company will tell the shareholders to pay 25 at one time. During application and allotment itself, company will ask 25 rupees. It will ask entire 25 to be paid during application itself. So we can't write application alone. We used to write application and allotment in this way. No calls will be there then. In lump sum 25 will be asked for per share. It is 25 rupees is per share. You have to divide 5 lakh divided by 25. No, it is already written 5 lakh shares. It is not rupees. So each share is 25. Total number of share is 5 lakh. So if you multiply, you can get total capital of the company. 5 lakh into rupees 25. This is number of share 5 lakh. I thought it is amount. Now you got it.
Yes, ma'am.
Okay. Now called up. What is this term? All these terms you are going to use, and it's a very big chapter, very big, and it carries huge weightage like shares, debentures. Both of you, when you add together in your boards, you will get 24 marks questions, okay, out of these two chapters, issue of debentures, issue of shares. We will be doing both the chapters slowly. Try to understand, practice a lot. Whenever you are having any doubt, ask. It has lot of weightage in boards, so try to understand the concept. Called up. Now what is this called up? Whatever amount company asks the shareholder to pay in first or second and final call, that is called up. Like on application, company asks the shareholder to pay 30, then on allotment 20, then on first call 30, then on second and final call 20. In this way 100 rupees collected by the company in different installments. So whatever the company is asking shareholder to pay in a particular installment, that is known as called up. So called up value means total amount asked by the company from their shareholders. Understood what is called up?
Yes, ma'am.
Yeah, I hope you people are writing there. Kindly write it down. Now see, paid up. What is paid up? Whatever amount shareholder pays to the company. It is not necessary that called up and paid up will be same. How called up and paid up will not be same? See, company may ask on allotment 20 rupees for example, and suppose company is having 100 shareholders. Just an example I am telling. 100 shareholder company is having in its company. Now company is asking 20 rupees to pay to each shareholder. So it is not necessary the 100 shareholder will pay. Suppose 80 shareholders pay, there will be 200 shareholders who are not making the payment. So paid up will be only for how much? How you will calculate paid up? Only 80 shareholders paid 20 rupees. So paid up will be 80 into 20 only. But company asked, so called up is what? Called up is 100, like 20 rupees. Called up is 20 rupees, but 20 rupees into 100. Okay, so 2 lakh rupees is called up value. But paid up, how much shareholders paid? Only 80 shareholders paid. 80 into 20, suppose. Okay, are you understanding my point, what I am saying?
Yes, ma'am.
So it is not necessary all the shareholder will make the payment. If all the shareholder makes the payment, then only called up paid up will tally. Otherwise called up and paid up will be different amounts. So called up means total amount of installment called by the company from shareholders. Paid up means total amount paid by the shareholders to the company. Suppose 1 lakh share of rupees 10 each, and suppose company is calling 3, 2, 1. 3 plus 2, 5 plus 1, 6. 4 is uncalled. Suppose 4 rupees now company didn't call. So in this called up will be how much? Called up will be 6 rupees only called up. Okay, and in this 6 rupees how much the shareholders are paying, that is paid up, and this 4 rupees is uncalled. Company is not asking now to pay. Fully paid means when shareholder pays full amount of share, like rupees 10. Suppose shareholder pays only 6, then it is not fully paid up. All these terms are extremely important here. Try to understand. See, fully paid. What is the meaning of fully paid? First you have to understand. There are two conditions for fully paid. Kindly write it down. Extremely important. Fully paid. When we will be doing the questions, if your concept is not clear, you will struggle. So try to understand the concept. Fully paid up, in order to satisfy fully paid up, there should be two conditions. If those two conditions are satisfied, then we can say fully paid up capital. What are those? See, first condition is, suppose face value of the share. What is face value? Like the amount company is ready to sell the share to public. For example, company is telling that per share 100 rupees. and for that 100 rupees company is selling to public. Per share I am talking. So that 100 rupees is the face value of the share, the price, original price of the share, 100 rupees. That is face value we call. Now suppose entire, listen carefully, entire 100 rupees company will ask in different installments, like on application some amount, on allotment some amount, then remaining on calls, first call, second call, in this way company will ask from public. Now entire 100 rupees suppose company received from few number of shareholders. Listen carefully. Suppose there are 100 shareholders and suppose 85 shareholders paid this 100 rupees per share. It depends on the number of shares each shareholder is holding. That's a different case and it's easy to calculate. First you have to understand, suppose 85 shareholders, they are paid per share 100 rupees, entire amount called by the company. That 85, how many share they are holding, you will see, and that will be multiplied by 100 rupees, and that you have to assume as fully paid. And the second condition, which is very important again, what is the second condition? Company is company is asking only 80 rupees out of 100. Price of the share is 100, and again I am repeating, it will be distributed in different installments. So company is asking only 80 rupees, not entire 100. Then it is not fully paid up. So in order to call it as fully paid up, this condition should be satisfied. First main condition, 100, the company should call entire face value amount 100 rupees. Those shareholders who paid entire 100 rupees called by the company will come under fully paid up, and those who didn't paid the entire 100 called by the company will come under not fully paid up. This is the concept. Suppose the company is itself not calling entire 100 rupees, it is calling only 80 rupees, then not even a single shareholder will come under fully paid up. Are you understanding the concept? Extremely important. Pavitra, Sachin, are you understanding, dear?
Yes, ma'am.
Okay. So Sachin, can you tell me what are the two important conditions to be fulfilled in order to be fully paid up share capital?
Ma'am, the first condition is when suppose 85 shareholders. One second. 85 shareholders are. Suppose 85 shareholders pay only a few amount of shares, but not.
Yes, you are right.
Yes,
You are right, dear. Tell me.
Suppose 85 shareholders are there, and only some amount of shares are paid, but not fully paid is called the first criteria. And second is that when the full like the same 85 shareholders pay the full shares like fully paid is called the second criteria.
Yes, very good. So the condition should be
Yes, ma'am.
Yeah, you are right. So you should focus on that when we will be doing the question. Fully paid up means first thing itself the company should call the entire 100 rupees. The first condition you should check whether company has called entire, that is called up. Company has called up entire 100 rupees face value of the share. If it is so, then you have to see the total number of shareholders, how many of them paid entire 100 rupees, they will come under fully paid up, and remaining who didn't pay entire 100 rupees, there will be some who will not pay entire amount to the company, they will come under not fully paid up. And another most important condition, suppose the company is itself not asking 100, it is asking only 80, not even a single shareholder will come under fully paid up, all will come under not fully paid up, because the company is itself not asking entire amount. Extremely important. I am repeating, write it down. So write this in your own words so that you understand. both of you, Pavitra and Sachin, the way you understand, you can write these two conditions in this fully paid up. Now journal entries, very important. These are the basic journal entries. See, example, 1 lakh share of rupees 10 each. Suppose company is having 1 lakh share, each share 10 rupees. Now how the company will ask from public? For example, during application, company will ask 3 rupees per share. This is value of per share, not 1 lakh share, per share. During allotment, 3 rupees, first call 2 rupees, second call 2. When you add together, 3 plus 3, 6, 7, 8, 9, 10. So 10 rupees company will get in each share in this way. Now, whenever company, first the application money company will receive. Those who are interested among the public, they will go and purchase the share of the company. During purchase, the public, they will pay application money 3 rupees. Okay, so company is issuing 1 lakh rupees, company will receive application money 1 lakh into 3 lakh rupees. Now what journal entry company will pass? Kindly put proper lines for journal entry, dear. Don't put like this, don't like L and all. You have to write all the amounts, all the zeros. So date, particulars, ledger folio, amount, debit, credit. Kindly put the lines properly right within that. Don't write like this. Now see.
Yes, ma'am.
Yeah. While receiving the application money, bank account debit, because cash is coming into the business. You should be thorough with these journal entries, then only you can solve the questions. Little by little I will teach you little bit. This chapter is hard, not entire, but if you understand it becomes easy. Let's see how much you are understanding, both of you. So bank account debit to share application. The first journal entry will be bank account debit to share application account. Since application money is coming into the business, so bank will be debited. It is an asset, and during which source it is coming? Application. So to share application account, 3 lakh, 3 lakh. How 3 lakh we got? Total number of share issued by the company multiplied by application money. So total number of share issued is 1 lakh. Application money per share is 3. So if you multiply, you will get 3 lakh. Don't write 3L and all. You have to write 3, then 5 zeros. Now the next. Being application money received, you have to write the narration. Being application money received, that's all. Now the second. See, whenever application money is received by the company, after that the company transfers that application money into share capital account. Share capital account is a liability. Okay, so in this, each and every installment amount needs to be transferred, which is received by the company from shareholders, because in future these amounts need to be repaid to the shareholders. This is not company's money. It's a liability. So share application you can't keep yourself. You have to transfer to share capital account, so that in future company will come to know how much liability company is having, how many shareholders it is having, how much money shareholders paid, and how much it needs to refund, all these. So in share capital account, this money will be transferred in the second entry. So share application account debit to share capital account. The total amount of application money received by the company from the shareholders, like 3 lakh, this will be transferred to share capital, and you can write being application money transferred to share capital account. Any doubt till here?
No, ma'am.
Okay. Now the third. See, third entry, once the application money received, now they become the shareholders of the company. Now company should inform them when the next installment should be paid. It should remind them through emails or through messages or through phone calls. It should remind its shareholder that on a particular date of next month you have to pay the allotment money. That is the next installment. For that, company again passes a due entry. This is a due entry. So share allotment, it should be received from the shareholders. It is an asset. For some time it is treated as an asset. This installment is an asset. So due entry we are passing now. Share allotment account debit to, again share capital you have to credit. Now in share allotment, see the question, 3 rupees. 1 lakh number of share issued, during allotment 3 rupee company will ask. So now the shareholder needs to pay 1 lakh into 3 lakh rupees again in the second installment, which is allotment. So this is due entry. Due entry means company is reminding the shareholder to make the payment on allotment. Share allotment account debit to share capital. This will be the entry. 3 lakh, 3 lakh. Again don't write L, write the zeros. Then you have to write being allotment money made due. After that the fourth entry will be bank account debit to share allotment. Once the company reminds the shareholder to make the payment, what the shareholder will do? Shareholder will pay the payment on due date. So company will receive cash at bank. So bank account debit to share allotment. That share allotment money 3 lakh, 3 lakh. Till 4 entries, any doubt you people are having there?
No, ma'am.
Okay. Okay. I hope you people are writing, right? Write it down everything.
Yes, ma'am.
Yeah. Total 8 entries are the basic entries which you should know. These 8 basic entries, with the help of these only we are going to solve from easy to hardest level of question. So basic entries you should be thorough. You should learn these entries. Now the fifth entry. After allotment, the next installment is share first call. Now company will again make a due entry. Company will remind the shareholders to pay the next installment, which we call it as first call. So again due entry will be passed in the book of company. Share first call account debit to share capital. These are the due entries. You have to again write first call money made due. Then you have to do the calculations. How many number of share issued? 1 lakh. What is first call? 2 rupees per share. 1 lakh into 2 lakh rupee. Company is... Yes, Sachin, you want something to ask?
No, ma'am.
Okay, fine. So, bank account debit to share first call account 2 lakh rupees, 2 lakh rupees. After that, the 7th entry. Then, fifth entry we did, share first call, that is the due entry. 6th entry. Now we have to do the 6th entry. The same, now you are going to receive this share first call from the shareholders. So bank account debit to share first call account. This will be the entry for receiving first call money. 2 lakh, 2 lakh. Then the 7th entry, the final call, 2 rupees, second and final call. Again you have to make the due. So share second and final call account debit to share capital. 2 lakh, 2 lakh. You have to write. You are making due entry for the second. Again you have to remind the shareholder on a particular date. All the shareholders, you have to make the payment of second and final call in this way. For that you are passing this entry. After that you will receive the final call. So for that bank account debit to share second and final call account 2 lakh, 2 lakh. So basic entries are 8. First application money you will receive. First the public will apply for the shares, that is application money. So that for that bank account debit to share application. Then that application money you have to transfer to capital account, share capital we call it. So share application account debit to share capital. Then allotment money you have to make due. Share allotment account debit to share capital. Then you will receive allotment money, bank account debit to share allotment. Then you have to make due entry for first call. Share first call account debit to share capital account. Then you will receive that first call money, bank account debit to share first call. Then again you have to make due entry for the final call, second and final call. All these are installments. So very easy. First application money you will receive, then you will transfer to share capital. Other like allotment and calls, you have to make first due entry, then for the receiving that amount. In this way. So till 8 entries there are. So share second and final call account debit to share capital, then bank account debit to share second and final call. Any doubt in any journal entries? Anything you didn't understand? Pavitra, Sachin?
No, ma'am.
Okay. Now see, if shares Please, that 90% kindly write it down, all the important tips and points, whatever I am saying. Now, it is mandatory that suppose company is issuing 1 lakh share, for example, minimum subscription should be 90%. People should subscribe to 90% of the issued share. Then only company will get permission to start its business. Otherwise, company cannot start its business. It is legally mandatory to receive 90% subscription from public on issued share. Kindly write it down. If 85 or 89, even 89% if company is receiving, company will not get permission to start its business. So, minimum 90% subscription of issued share capital is mandatory. Kindly write it down as important note. Okay?
Yes, ma'am.
Yeah. Now see, if shares are issued to promoters, sometimes company issues shares to promoters. Now who are these promoters? See, at least if a company, somebody is going to start a company, the idea should come to somebody's mind. It's not automatically some magic will happen and a company can be established. No. If a big company needs to be started, there will be a group of person or even a single person to whom the idea should have come of starting a company. Then only he will take the actions and the company will come into existence. Not into any magic or anything company comes. So those persons into whose mind starting a company comes and they have taken the initiatives, they started the action to start a company and who have worked hard to start a company, those persons are known as promoters. Okay, now to them the company will issue shares. So what will be the journal entry? If the promoters receive shares from the company, first you have to debit incorporation cost account. Okay, incorporation cost account debit to share capital. Incorporation cost means at the initial stage of starting a company, there will be some cost, some expenses promoters must have done. For that only company is issuing shares free of cost to them. So incorporation cost is an expense you are debiting to share capital account. Understood?
Yes, ma'am.
Yeah.
Yes, ma'am.
Okay. Now for share issue expenses, sometime during the time of issuing shares, lot of notice needs to be published in newspaper and in news or any other things. So for that expenses needs to be beared by the company. Prospectus are issued. For all these expenses needs to be incurred by the company. So for that, what journal entry you will pass? Share issue expenses account debit to bank. Share issue expenses account debit to bank. For issue, for share issue expenses, this journal entry you have to pass. If it is given in your question, you have to pass this one. Then the next, if shares are given to underwriter for their commission. Now what is this underwriter? See, underwriter is a person who promises the company that don't worry, I will help you minimum 90% of the issued share to be sold in the market. He promises, for that he charges commission, because what I said to you, it is a legal mandatory condition that company should at least issue 90% of its share capital to public, then only it will be allowed to start its business. And it is not possible for any new company, because public don't know whether the company will earn profit or suffer loss. So many people, they will not invest in that particular company. So the company takes the help of underwriter. Company tells that we will pay you the commission, you kindly help us to make the sale of this 90% at least, so that we can start our business. So underwriter is a person who helps the company to at least sell 90% of its issued share capital to public. And sometimes underwriter says even if the public doesn't purchase entire 90%, the remaining percentage I will purchase from you. So in this way underwriter helps by charging commission. So for them also share capital is issued by the company. So for them there will be two journal entries. First, underwriting commission, it is an expense. Underwriting commission is an expense. All the expenses as per the rule you have to debit. So underwriting commission account debit to underwriter's account. And for underwriter you need to make the payment, his creditor, you have to make payment to him. So underwriting commission account debit to underwriter's account. Now you are going to make the payment through issue of shares. So underwriter's account debit, you are closing the liability. You are making payment means now no more liability. So underwriter's account debit to share capital. We are issuing shares for making payment. If you are paying through cash, then underwriter's account debit to cash, or if you are paying through check, to bank. If you are paying through bills payable, to bills payable. Everything depends on the question how the payment is made. If it is made through issue of share, then to share capital will come. Understood or having any doubt so far, dear?
Understood.
Okay, fine. I hope you people are writing everything, right?
Yes, yes.
Okay. Now issue of shares. See, shares can be issued, okay, at par and at premium. At discount nowadays, issuing shares at discount is not possible. Previously, like many years ago, this was possible. The shares was issued by the company at discount, but nowadays it is not allowed. Company can't issue shares at discount, but company can issue shares to public at par and at premium. Now you have to understand what is this par, what is that premium. See, suppose the original price of the share is 100 rupees, or we can take 10. Okay, in this it is 10. Suppose 1 lakh number of share is 1 lakh. Okay, the company is having 1 lakh share to be issued to public, and the original price is 10 rupees. Now this 10 company will ask at different installment, like on application 3, on allotment 2, on first call 3, on second and final call 2 rupees. So this, if the company is issuing 1 lakh share at 10 rupees, that is the original value of the share, which is known as face value. Kindly write it down. Original price of the share is known as face value. Okay, FACEVALUE. So face value of the share is 10, company is issuing at par. At par means issuing the share at face value. 10 rupee share issuing for 10 rupee. This is the meaning of at par. At premium means the value of the share is 10, but company is issuing for 12. 2 rupees extra company is charging. So this 2 rupees is security premium, and all company cannot charge this 2 rupees extra. Suppose already there is a company existing for more than 50 years, 60 years, and it has a very good name in the market, for example, and now it needs some funds to expand its business and it is issuing share. Then people know that this particular company is doing well, earning good amount of profit, and it is in the market for more than 50 years or 60 years. So definitely if we invest here, we are going to get a good amount in return. So if that type of company issues its shares for more than face value, like 10 rupee share, if it issues for 12, people will rush there to purchase. They will not see the 10 rupee share company is selling for 12, because they know even if they spend 12 rupee per share, they are going to get more than that. Company will earn profit. Are you understanding my point?
Yes, ma'am.
So this this 2 rupee will be income for the company, extra income per share. I am talking about per share only. You have to do the calculation with total number of share issued. So till here we will keep today. Okay, in the next class we will continue the chapter. Kindly don't miss the class. Chapter is very lengthy, very important, and difficult concepts will come. So it's my request not to miss the class. That's all. Okay.
Yes, ma'am.
Yeah. Thank you, dear.
Yes, ma'am.
Yeah, thank you.
Thank you, ma'am.
Yeah,
Thank you, ma'am.
Thank you.